All right, we are going to take a look at a 35-year-old male in this case study, and we're going to look at a couple different options. We're going to look at how to fund a policy, design it for maximum cash value and flexibility, but demonstrate the flexibility as well. It's one thing to hear, hey, a policy is very flexible, completely different thing to see it in action. Okay, show me the numbers of me varying my payments over time to see that it can actually work. And then once we've optimized the policy for cash value, how do I put it into action? So if I'm 35 years old today, I'm building a policy. Perhaps my goal is to pay for college for my two-year-old son now, or two-year-old daughter. So I want to build the policy up, and then how do I actually use it in the future? So some things we're going to look at here. One, we've got a 35-year-old male. Options we're going to look at here. We've got flexible funding and college planning. So we're going to look at the application of policy loans here. And then also we've got a long-term savings aspect as well, as we are just building cash value over time. So what we're going to look at on the funding is $30,000 per year. So obviously when we design a policy, what's the most important piece? Money can go where in a life insurance policy? Two primary areas. We have the base premium, which first purchases me life insurance, very little shows up in cash value. And then I have the paid up additions rider, or PUA rider. English translation, cash dump-in. It does purchase you paid up additional life insurance or death benefits, but why everyone is interested in this component is because it grows the cash value right off the bat. That is the point of interest. Then we've got the limits as far as how much the insurance company allows us to add on top of the premium piece. The company we're going to look at here is 10X. So if I want the ability to pay $30,000 per year, that premium can be as low as what? $3,000 per year. The ability to put another $27,000 per year into the PUA component. And then the other limit I have is our MEC limit, which in this example, we have just about at $30,000, a little bit of extra space. If I want the ability to pay into a policy for a long period of time, we typically like to overinflate that a little bit, just as we stress test a policy to make sure we don't run into a chance of a MEC occurring at any point in time down the road. So that is what we've got for the design. Now, one other thing with the funding, we touched on flexibility, meaning I want to be able to pay in $30,000 per year, but I don't want to get a bill for it. Meaning, what if life happens? Am I obligated to make that $30,000 payment every single year? The answer is no. This is where not only a minimum premium gives one more cash value, but it also provides a ton of flexibility in the event that life happens. So first, let's look at flexible funding. This is going to line up with the long-term savings as well, because we're going to look at what the policy looks like when I pay money in, just let it sit and grow, with a consistent payment of $30,000 per year, and then payments bouncing up and down, which will be kind of neat to see. And then we'll look at the college planning aspect, where we look at policy loans, paying them back, and then not paying them back, not paying any interest, nothing at all. So this way we can see everything up front. So again, we've got a 35-year-old male here. Let's take a look. All right, so 35-year-old male, $30,000 for 15 years. Can fund shorter or longer, but what he wanted to see primarily was payments going up until age 50. Does not want to pay anything into the policy after age 50. He might still, he says, hey, if things change, I might want to do that, but I'm pretty certain that I don't want to have to pay once I'm age 50. Like, I want to stop. Nothing else goes into this policy. So of course we want to listen to that and make sure we set the policy up accordingly. So paying $30,000 per year, if things go according to plan, traditional policy geared for long-term performance. By year 5, I've paid in $150,000 and I have $150,000. Year 1, my cash value is $26,000. This is a 10/90 split, meaning of this $30,000, we have a premium of $3,000. We also have a term rider attached as well. That's why my cash value is not a full $27,000. There's also a PUA feed embedded into the policy as well. Point being, we still have the policy minimized in terms of expenses, the base premium, to optimize the short-term and long-term cash value. So here's our perfect world scenario. If we pay money in, just continue to let it grow over time. We can scroll down here. Cash value continues to appreciate even though I pay nothing else in. But let's look at this guy. So here's the exact same policy. And the first 2 years, I pay in $30,000. And how does your cash value and death benefit look when you compare it to the example where you paid in 30 for 15 straight years? Identical first 2 years, because it is an identical policy. We didn't make any adjustments or anything like that. Same company, same health rating, all of that good stuff. We want to show adjustments after we start a policy where we cannot make changes to the base premium, the death benefit, just to our funding. How do we do that? Well, the company is designed for flexibility, so I can bounce my payments up and down. We see years 3 and 4. I'm sorry, 3 through 6. Life happens. We can still fund it, but only at half of what we could before, $15,000 per year. Okay. Break-even point, still solid between years 5 and 6. The base premium, by the way, is consistent all the way through at $3,000 per year. Now, after that, what do we see? Year 7, we've got to kick the payments down further. We'll pretend life happens, down to $10,000. Then for the next 3 years, down to $5,000. But then things start to pick up again. $20,000, then $30,000. And this design was done with a company that's typically not that flexible. So it was actually done with one of the 4 major mutual carriers, Mass Mutual. We just imported the data from the illustration to the Excel spreadsheet, but we did use the proper riders in order to build in flexibility. And here's the important thing that we need to know from the technical aspect to make sure we don't run into an issue down the road. And that is, going down, reducing my contributions is easy. When I want to increase a payment with an insurance company, so from $5,000 to $20,000 and then up to $30,000, a lot of times insurance companies come back and say, okay, if you want to increase your payments all of a sudden, we want to put you through medical underwriting. Some type of underwriting, because when we add funds into PUAs, that does purchase us additional whole life insurance death benefit. Now, with that said, if a policy is constructed properly, and what you need almost every time to avoid underwriting is this guy, a 1-year term rider, which this has, that gives one the ability to add funds into PUAs really at any point in time without having to go through medical underwriting, and we keep the convenience factor embedded into the policy. Because if I'm 35 today and I want to increase my payments when I'm 47, is there a chance that my health declines? I'm not as healthy as when I first started. Definitely. Maybe I still am healthy, maybe I'm healthier, but if something happened and I have to go through underwriting, I might not be able to get money in. If the policy's set up properly, like it is here, it's designed with the proper riders, minimum premium, all of that good stuff, this gives us the ability to optimize the cash value, short-term, long-term, bounce payments up and down, and it can continue to keep funding too. So it is interesting to see the flexible funding here. And if you'd like to see this on the detailed illustrations from the actual insurance carrier, we do have material on this in our membership program, which you can subscribe right on our YouTube channel. So here is a growth sample. Let's take a look at college loans now. So what we've got here, the scenario where we pay in $30,000 for 15 years compared to the loan sample. And we can flip this, we can look at the flexible funding scenario, it doesn't really matter. But what we are assuming here is when we start the policy, we've got a newborn. Growth sample is exactly what we saw in the last slide. Now, at age 50, when I'm no longer funding the policy, time to pay for school. So this example is going to represent what the policy looks like if I borrow $50,000 per year for 4 years to pay for college. So these are policy loans. And then eventually repay it. When we are taking these policy loans out, the policyholder, if you're the policyholder, you state, okay, when I'm taking a loan out, Steve, I do not want to have to pay loan interest or pay anything back. Like when I take the loan out, I want my money, pay for college, don't send me a bill to pay interest only or anything like that. So here are the annual loans coming out, $50,000 per year. Here's my loan balance. So the first year, when I take $50,000 out, I want to know the impact of that policy loan. Because remember, this is a life insurance policy. So if I take this $50,000 loan out, you may recall this from earlier videos and case studies, is I am going to continue to earn dividends on my full cash value as if I never touched it in the first place. There's no lost opportunity cost. That same dividend rate, same guaranteed rate is applied to my entire bucket of money. Now, how the company does this is when I take that policy loan out, my cash value is my equity, the gauge that determines how much I can borrow. So look what happens here. I pulled out 50, cash value is 563. Compared to the example when I just let it sit and grow, cash value is $616,000. Now, next, let's look at our death benefit. So the company tells you we're still going to pay the same dividend rate. In this example, for 2021 with Mass Mutual, it's 6%. Why would they still pay you a 6% dividend on money in cash value and on this $50,000 as if it were still in the policy? You borrowed it out. What is the collateral? The death benefit. So anytime we take a policy loan out, compare your death benefit. In the example where we just let it sit and grow. And then when we take a loan out, subtract $50,000 from that figure, what do you notice? Dollar for dollar reduction. So if I die with a loan outstanding, the company is going to pay the death benefit out minus the loan balance. This is the net death benefit, by the way. So we continue to take $50,000 out. Here is the loan interest column at 5%. Now here's what I want to touch on as well, and this is even more challenging to follow in a full illustration from the insurance company. So year 2, second year of school, we pull out another $50,000. My loan balance increases to $102,500. The reason why is this loan interest of $2,500 is due, payable to the insurance company, but I'm not paying it. Not this year, not yet. So what's happening is I borrowed out another $50,000. So I've taken 2 loans out, net out of pocket I've received, or into my pocket is $100K. But if I do not pay the loan interest, the policy will borrow from the cash value to satisfy the loan interest bill. It's going to pay for it internally, which will deduct from the death benefit as well. Slow down cash value growth a little bit. And that continues to happen each of the 4 years. So this is why by the 4th year I have pulled out 50 times 4, $200,000, but my loan balance is what? $215,000. That is a result of the loan interest that has accrued, and I completely ignored it because I said, I don't want to have to pay it. My focus here is paying for my kids' college, and that's it. I do not want to pay it. You, Mr. Insurance Agent, told me I did not have to pay it, so I'm not going to. You ever feel like that? With anything, not just life insurance. So, in this example, no repayments while we are borrowing. There's my cash value and death benefit at the end of the college funding span. Okay. Now let's look at repayment. So we start repaying it here at $2,500 per month or $30,000 per year. So take some time to pay this loan down. This represents the loan interest here in light red. Loan interest goes where? Some times there's information out there that makes it appear as if the loan interest goes back to herself. Pay yourself interest. The interest goes to the insurance company. That's where it goes. They still pay you interest on your entire cash value. Just like if you own a piece of real estate, if the fair market value appreciates by 5% every single year, if I take a loan out, there's interest on that loan. Where does it go? To the bank, to the lender. If the fair market value still appreciates by 5%, my entire property value still appreciates by 5%, not just my remaining equity. Exact same thing here. What's collateralized again is the death benefit. But here's what I want to touch on to kind of validate all of this. When it is repaid, look at your cash value and death benefit and compare that to the example on the left where we never touched it. What do you notice? Cash value and death benefit are 100% restored to exactly what they would have been as if I never touched it in the first place. This is where it's attractive to some to use these products for college planning, not only because as I build up cash values, that is not considered an asset on my personal balance sheet. I don't have to always disclose that if I'm applying for financial aid. So that's money I can still continue to build up there. But if I decide to use it and I'm in a position where I say, hey, I can or I want to pay it back, or maybe I treat it as a student loan to help my son or daughter instill some discipline within themselves, they're going to pay it back. What you'll find then is everything's fully restored. You continue to receive the compounding on the full 200 as if you never touched it in the first place. Again, we want to account for the loan interest repaid. That's why we put it in this column. Now, let's assume that you wanted to build it up, take out loans for college, and not pay them back. Because that could very well be the case. Let's take a look. On the left, we've got the same scenario here. $30,000 for 15 years compared to the exact same scenario, $50,000 in loans for 4 years, beginning at age 51. But never paying anything back. So let's take a look. Here's my loans through year 4. Loan balance is that same $215,000. Remember, in the repayment scenario, we did not pay anything back during the 4 years when we were taking those $50,000 loans out. We didn't pay anything back then. Now, year 20, when I'm age 55, my loan balance increases from 215 to 216. The reason why, here's my loan interest that comes due, but I say, I don't want to have to pay that. Like, that's not what I was told when I purchased the policy or when I decided to purchase it. Like, I don't want to have to pay anything back. So if we don't, what happens is we do get a bill for that loan interest, but if we do not pay it, the policy will borrow from the cash value to cover that loan interest internally. So we just let it ride forever. In this case, we'd be perfectly fine as that loan balance continues to grow. Remember, we're still earning dividends on the loan balance as if we haven't touched it, but we still have plenty of positive equity in there. So you're earning dividends on your full cash value and money that we've loaned out. So dividends on everything. Interest is accruing only on the $200,000 you borrowed out. It's compounding over time, but you've got much more positive equity here, which is going to outpace your loan and loan interest there, which is good. If you overloan a policy, if we do something like pull out 80 or 90%, you'll see, especially in today's interest rate environment, the loan interest typically exceeds the interest earned on a policy. It'll always happen with whole life. IUL, you can project with indexed universal life, you can project the interest earned outpacing the interest due, but we've never seen that actually happen, which is a bit dangerous in my opinion with IULs. But that's another subject. Here we go. If we look at this at age 90, what is the overall impact? If I never touched it, I paid in $30,000 for 15 years. So a total of $450K. That would have been my net out of pocket. $3 million in cash, 3.4 is what's paid out. versus this guy. So I paid in $450 out of pocket, but then I pulled out $200K in loans. So my net out of pocket would have been what? $150K. Cash value, 1.7. Death benefit, 2.2 million. Still a decent amount. Now, it's a significant difference when I compare the two, but again, depends on my situation. And what's very important, in my opinion, is seeing this kind of stuff up front. Instead of just being told, hey, you can use it for college planning and such, what does it actually look like so my expectations can be set properly? So know this was a lot of information, a fun case study, which can really apply to any age, right? So we've got a 35-year-old male here, but it really doesn't matter. If you have any questions or would like to see custom samples, feel free to reach out anytime, or if you'd like to design a policy with us, have it custom built for you, we'd be happy to do so. But as always, I hope this helps, and we will talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.